What's up, everybody? Eric here, and I am back with David Hunter. I was just chatting with him real quick before we started. This is the fourth time he and I are meeting, and it's actually really useful, at least from my perspective, because I get to understand his thought process. Then, as we get new data, how that impacts his thought process, because really you're teaching us different ways to think about markets and the economy. And I think that that's just tremendously valuable. So, first off, welcome back. Great to have you.
Yeah, thanks, Eric. Glad to be back.
Yeah, and since the last time we spoke, there's been no shortage of drama in the economy and the market. So I'm really eager to get into, how you think things are rolling out and what you're looking at. So I figure we could start a little bit about the broader markets. Last time we spoke again is about 3 months ago. We were talking about this idea of recession, and I had asked you if you thought we were in a recession at that point. You said you thought so, if not right on the precipice of entering one. And I'm curious, how have your thoughts evolved around that concept? What are your thoughts on our position in relation to a recession?
Yeah, for sure. Since I think we spoke in June, so
Yep.
so after that last conversation, we obviously got second quarter GDP in later in July, and it confirmed that we had 2 quarters of negative GDP, which by traditional definition that's a recession. There's lots of ways to kind of look at what is whether it's a recession or not, but I think for sure the economy's weak. I think technically we're in a recession. I think more than technically, the economy was showing negative GDP. Third quarter we bounced a bit, not a lot, but a little bit. So, you can argue that we may have stopped the negative, but I think we're heading for much deeper weakness. And so, you know, you're going to, in recessions, you're going to go in and out of GDP, positive GDP, negative GDP, until you really get into the depth of the recession. So, my view, which has not changed, is that we're on our way to a global bust. I define a global bust, actually a global deflationary bust. I define that as something bigger than a recession, but not as long as a depression. It might have some of the characteristics of a depression, but happen in kind of a concentrated period of time, like a year. So I think 2008-9 was almost a bust, but they saved it before it really got into that. So I think this time we see something worse than 2008-9, which would make it the worst since the Great Depression. Um, and I think it'll be accompanied by a financial crisis, the likes of which we have not seen, so bigger than 2008-9. Um, and that means, bank failures, a lot of involuntary debt liquidation, lots of unpleasant things. I think that's likely second half of 2023. I don't, you never know exactly when, because we're a recession into a global bust isn't two different things. It's just it takes a while for you to move into the real depths of it, and to where you get to the point where the financial crisis gets big enough where it causes a bust. So, like I said, we haven't seen one in the post World War II era. We came close in 2008-9. I think this is going to surprise people in terms of the magnitude. But before we get there, you're going to be kind of going through this period of up and down. Are we in a recession? Are we going to have a soft landing? Are we going to have a hard landing? Ultimately, I think we're going to have a hard landing.
Well, that actually leads beautifully into my next question, which is last time we talked about exactly that, the concepts of soft landing, hard landing, and the way that markets have been moving in relation to which one of those is more likely. Last time, you also felt that we were more likely leaning towards a hard landing. It sounds like that's about the same. Has there been any additional data input that has reinforced that hypothesis, or is it essentially just ceteris paribus, nothing has really changed, same, same?
Probably the thing that has just increased the probabilities of a hard landing and increased probabilities of a global bust is the Fed's intransigence in terms of rate hikes and feeling like they have to go a lot farther. As I keep saying on Twitter, I believe the Fed, the current Fed, is making perhaps the largest policy error in history, certainly in
Mm,
the history of the Fed. And what that means is I think they are over tightening. We've seen rate increases at a speed that is beyond, there's no precedent for the speed with which rates have gone up. And the Fed doesn't think their work is done. They keep talking about another 75 and maybe another 75 in November, December, and then maybe pause there, or maybe do some more hikes in 2023. That's got the market very spooked, and for good reason. Again, they haven't really even, they've just begun quantitative tightening, meaning pulling money out of the system. But these rate hikes are unprecedented and I think are having a dramatic impact. Just look at mortgage rates. Mortgage rates went from 2.5% to 7.5%, almost 7.5% here in a matter of, within this year. And, in past times, this is what really surprises me. In past times, I've been through many cycles and have watched the Fed through many cycles. Oftentimes, they overshoot, but what typically happens is they start hearing from, the realtors and the banks, industrial companies, and again, they all have their um, spokesmen that speak for the whole industry, and they get to the Fed and say, we're in maximum pain now. You've got to back off. The Fed seems, I'm sure they're hearing from some of those folks, but the Fed has shown an inability. It's almost like they've got their ears closed and blinders on, and they're saying we don't care what pain is going to happen short term because we think that's so necessary to get inflation down. And they are, I think this is a Fed that's way over their head. I don't think it's the most qualified Federal Reserve or FOMC we have ever had. In fact, I think it's being led by a lawyer who has bought into I think, a very false narrative or a bad narrative, in terms of thinking that he's got to drive the stock market much lower to impact financial conditions to the degree necessary to get inflation down. I think that's a very false narrative. It was started by Bill Dudley, who's the former president of the New York Fed, former senior economist at Goldman Sachs. It's probably the dumbest thing, or most dangerous thing that's come out in a long time, and yet he convinced Powell that that's important, that should be their primary focus, and Powell has very clearly indicated that that's his intention, and that's what we've seen for several weeks to the last few months. Particularly the last few weeks, he's trotted out all his FOMC members speaking from the same hymnal, constantly saying the same thing, and one trying to up the other one in terms of sounding more hawkish, trying to scare the market down. That's his whole intent. And we saw last Thursday, a week ago Thursday, the market opened and went straight to 3,500, and it broke some levels that people thought were important technically, and just cascaded down to 3,500 in the first hour of the open, and then reversed. That was driven by comments, more hawkish comments, and ever since he's continued that. I think they believe minimum we've got to get the market down near 3,000. And I think Dudley really believes it has to go a lot lower than that. So maybe Powell does, who knows? I think they're going to be have their head handed to them. I think they're going to be surprised that they don't control the market. But for a while, their rhetoric did scare the market, and that was what really has pushed the market down and kept it down. And every time it lifted its head, it'd go back because they'd send out some more speakers. It's just a very amateurish way to run policy, in my opinion, and it's also a very wrong-headed narrative that he's bought into. But the good news is, the markets can overpower the Fed. The Fed thinks they're in charge. They're going to be surprised that the markets will move against their efforts. And today you see the market up, the S&P is up almost 80 points, over 2%.
Yep.
And that was the result of one or two Fed officials coming out and softening their commentary, so they weren't quite as um, aggressive in stating that we have to do another 75 and we have to do another 75. Mary Daly, who's head of the San Francisco Fed and has been talking like all of them very hawkishly, just indicated that maybe we need to consider that we're causing harm overseas. There's risks rising all around the world. Maybe we need to think about softening our approach here a bit. Maybe we need to, if not pause, at least hike less aggressively for a little while here and see what comes. Because that's the other thing that I think is amateur hour about the Fed is that they don't understand leads and lags. They give lip service to it, but the leads and lags are quite lengthy. So they're looking at current, when the CPI comes out, it's the last month's CPI. So they're looking backwards and determining forward policy based on a number that's already a month old, and with a number that is with a inflation that is typically a year lagged at least. So in other words, if they're going to conduct policy based on old news, they're guaranteed to go way too far in their tightening. And my belief is they've already done that. As I say, the seeds for a global bust are already sown. In other words, the tightening they've done already is way past where you've already created a hard landing, and that hard landing is going to become something even worse than a hard landing and a global bust. And again, it's global. What also surprised me is that the Fed is not hearing from central banks around the world saying, ease up, guys. You're causing us a lot of pain. We can't handle it. We don't have some resiliency you have. You saw it in the UK when the gilt market went crazy, and there was, the pension funds over there were at risk. You've seen it, in other countries, in other areas around the world. Japan's going through some of its self-inflicted, but they're going through some real problems that I think are down the road going to cause real problems for them. But it's surprising because in the past, you would see the central banks get together and do a coordinated, easing, or, in this case, the dollar's very, very strong against all those currencies. And normally you'd see a coordinated, effort to get the dollar down because it's putting a lot of strain on countries around the world and on other currencies. So the fact that we're not seeing that is troublesome because it indicates either the Fed is, basically deaf to all the conversations they're hearing, or that we have central banks around the world that are all over their head and not really doing what we would have seen in past cycles. And that is my concern. I think we clearly have a situation where inflation hasn't been around for 40 years. So you got a lot of people in these positions that never lived through the early 80s. I did. And, they all think we got to do what Volcker did. Well, there's, number one, that's a very different situation. Number two, the pandemic happened. And so a lot of what's happened here is related to the pandemic in terms of inflation. Ukraine happened, Russia's invasion of Ukraine happened. That also is something that's different than the early 80s. So you've got a lot of things here that you got to sort through and realize this isn't just simple, well, this is the first time we've had double-digit inflation or close to double-digit inflation since the early 80s. We got to follow Volcker's playbook. He was a hero. I'm going to be a hero. I mean, I don't know what's going through Paul's mind, but he has invoked the Volcker edict many times and said he's trying to basically emulate that. So So it's very concerning right now that we have a Federal Reserve that may think they have a handle on things, but really don't. Um, so in the end, I think they're closer to the end of their tightening, whether they realize it or not, because I think the markets will ultimately force their hand. Um, and the economy is moving towards a place where they're going to finally wake up. But who knows when exactly they're, and the street, in typical street fashion, they get caught in narratives. So they think you've got to have a Fed pivot, meaning Fed lowering rates again, before the market can move. And I've been pretty clear that I don't think that's what's coming, that the market will move before the Fed. Both the bond and stock markets, I believe, will start rallying before the Fed pivots. And today's a good example. All you need is a little change in the rhetoric, and the market will, have a more hopeful movement. And then, it's not going to be a straight line. All you need is them to come out next week and reiterate their hawkishness. Have a couple of speakers come out and reiterate hawkishness, and it can take a step back again. But ultimately, I think we've seen the lows in the stock market last week, and I think we're beginning what I call the final leg of a 40-year secular bull market.
One of the things you mentioned that I'm really curious about from a personal perspective is the Fed's receptiveness to kind of foreign partners expressing concern over the way we're approaching rates and inflation. One of which comes to mind is the UN. I saw an article, I don't know all the details behind it, but essentially they were asking the US to chill out with the interest rate raises. That made me really curious because I anticipated that the Fed is wise enough to understand the impacts of what they're doing on the global market and other economies. And I thought it was interesting that the UN chose to essentially ask them to stop. I don't understand why they went about it that way. Is it literally like a last ditch Hail Mary? I assume they must have already talked before, they come out with an official statement asking the US Fed to stop raising rates. Do you think that the UN is just backed into such a corner now that that's where they thought was the last chance for them to get any reprieve from the rate movements?
Frankly, the last person I want to take advice from on how to conduct monetary policy is the United Nations. So they're I'm sure some of their constituents are concerned about what's happening in the world economy. So I think it comes from there, and they're seeing some of the strains, I'm sure. But it's really the other central banks and other central bankers that, and I have no doubt the central banks are talking. I'm not saying that Powell is shutting down communication at all. I'm sure he's hearing from others. Like I said, I'm not sure what others are saying. And they don't speak in one voice either. So he may have
Right.
heard from some that are concerned. But the ECB, I think, is probably a bit wrongheaded, just like he is. The Bank of England, I think, is. They all are focused on inflation, and I think at the without understanding that with the leads and lags, the real risk now is deflation. I think, as I said, next year is a global deflationary bust, in my opinion, and they're all worried that inflation's running away. So they're kind of caught in what I think is yesterday's problem, and because of leads and lags, they're staying the party way too long on the tight side. So it's not that he's not hearing, that he's refusing to hear. I just think they are in a mantra right now. They're locked in a narrative, or believe that the most important thing right now is to defeat inflation. And their idea of defeating inflation is we need to see the signs in the CPI. In the past, CPI wasn't even something the Fed paid a lot of attention to because it's a flawed index. But for whatever reason, it's the headline index, and certainly since June, Powell has made that front and center. so that the market makes that front and center. Every time there's a CPI release, a monthly CPI release, that's watched as closely as the jobs number, the monthly jobs number. And like I said, in the past, the Fed looked at the consumption deflator, and that was their primary one. That tends to, not be as the big swings. So there's just a lot of reasons why I argued that this FOMC, led by this guy, and I've been, critical of him in the past, but also complimentary at times. But I personally think Jay Powell's way over his head.
So, thinking about the Fed handling all of this, one of the things you were talking about is the market potentially forcing their hand to kind of pause their campaign on raises. I'm curious, what do those market circumstances look like that would cause the Fed or Powell to then take a step back and say, okay, we need to stop raising rates here, or, whatever other pivot they think makes sense?
It's going to be the economy and inflation. Probably it could either be either one. That what we're setting up for, and I don't have a prediction of when it's going to happen. Like I said, it starts with something like today, where some FOMC members, maybe they've heard from people, or maybe they're just using their own heads, but they're beginning to question, how far do we go before we pause? Because that's the other thing, and this is another sign, not to jump around, but this is another sign of, I think, Powell's, I don't want to say inexperience, because he's been on the Fed for a number of years, in this role and prior to that. But he's an attorney, and he's a financial guy. He's not an economist. And the problem is that I think he's seeing this as linear. So in other words, we've got to do all our tightening now. Again, in previous times, not that other Fed chairmen haven't made plenty of mistakes, but oftentimes you tighten, and then let's go back to the early 80s. We had a double dip recession. In 1980 you went in, you came out of it in 81, you went back into it in 82, and it was because they didn't do everything in a straight line. They paused to see what, because of the leads and lags, you don't know what damage you've done for many, many months. And if you just kind of decide, we're going to go here because that's, we're going to go until we see the inflation come down, you've gone too far. So, what you're going to see, I think, at some point in the next, I'd say, next few months, is a pause where they're going to at least finally wake up to the fact that, hey, we don't know how much damage we've done. There's plenty of signs that we've done a lot of damage in housing. There's plenty of signs that the consumer's starting to have problems. And industrial is obviously having problems. Commodity prices have come down. Maybe we need to pause and see what the effect of all these hikes that we've done since April, April and June and July and September and soon to be November. All those hikes. Maybe we need to pause because we've taken rates from almost zero up to over 4%.
Right.
And maybe we need to step back. And I think today was kind of the beginning of that unfreeze. And I think as we move forward in the next couple of months, you'll see more of that, because I think the economy is going to be softening. Certainly housing is going to be showing a lot of pain. Autos probably. Anything interest sensitive is getting hit now. And so, and the other thing that kind of, along with inflation, he's saying, okay, we have a double mandate. It's employment basically and inflation. Inflation's too high. We're going to work to get that down. We're going to stay tight because of that. And we're not worried about being too tight because employment's pretty strong. Well, employment's another laggard. You're not going to know, you're not going to see the employment tip until way too late. So he's using, again, he's not showing that he really understands leads and lags. And I keep repeating that, not just here, but, in all my commentary, is that That's really the issue. Is there's long leads and lags to policy, and if you don't understand that, you almost guarantee that you're going to overstay on the tight side and create a crack up.
What's the risk if they do take that pause? Like, what would stop them from taking that pause and seeing how things go? Is it simply the appearance that they don't have it under control still? I don't understand the downside if they go through cycles of raising and they apply that methodology where they say, okay, we've raised, 75 basis points, 3 quarters in a row or whatever, or 3 meetings in a row. Let's take a pause for a cycle and see what happens. Why don't they do that?
Yeah, it's. I think there are a couple of reasons. One, they got criticized roundly for being late to fight inflation. They viewed it, and I don't even hold him. People take him to task for that last year that he called it transitory, because he was right. Some of inflation was certainly transitory, and I think he was right about that. But this year's inflation took everybody by surprise, certainly him. And
Mm.
so I think he's taken it very personally, and I think the whole FOMC, that they've been roundly criticized for being late to understand what they needed to do. And I think they're trying to make up for that by being overly tight now. And they've even said it themselves. They're worried about their credibility. They're trying to protect their credibility by staying tight to say, see, we really, yes, we were late. We admit we were late and we should have tightened sooner. But now you're seeing we're real inflation fighters. And I think they're overdoing their concern about their credibility. I mean, the focus is do the right thing for the economy, and
Right.
set the right policy. And I think they are, but anytime you allow your personal credibility to be part of the argument, I think you run a risk of an error. That's number one. And I'll go back to Dudley. Dudley's thesis about the market having to go a lot lower to to defeat inflation is front and center with the Fed and certainly with Powell. And I think that's more than anything else right now the reason why he's afraid to pause. If he pauses, he knows the market will, just like today. I'm sure he doesn't like today because he wants the market down. And today the market's up 2% and looks like it's running. He doesn't want that at all because he's bought into Dudley's thesis. So I think every time we rally, it's pushing off his willingness to pause. Not that he was thinking about it anyway. I think he's the the positive thing about Powell is I think he's been very transparent and very sincere about what he's trying to do. I don't think at all that he's playing a game, or you know you get that a lot as people are
Right.
distrustful of the Fed, so they always think they're kind of doing this on purpose, or trying to hurt the economy for New World Order reasons, um, or that he's lying to us. He's saying it, but he's not really meaning it, or whatever. No, I think he's very transparent, very sincere. I think he's a decent man trying to do his job. I just think he's very wrongheaded and over his head, and making a big error.
One of the things we talked about last time, and you touched on it earlier, was the housing market. And the hypothesis was that we would see some contraction in the housing market, which we certainly have started to see that. I'm a little surprised at the relationship, though, between what we're seeing happening with rates and subsequent housing prices. It doesn't seem like housing prices have contracted quite as much, at least as I would have anticipated, with rates going where they are as fast as they are. But obviously, I haven't been around as long as you have. So I'm curious what you think about that relationship and where you see the housing market moving over the next 6 to 12 months.
Yeah, I think the next 6 to 12 months is going to be pretty awful in housing. I think what you get is, and you certainly saw it in July, you had a spike in rates in early June when we got the CPI out and the Fed did their first 75 base point
Mm.
hike. Um, and then through the balance of June and through July, rates came down. Um, And what you get is all those people that felt they missed their chance to buy a house because rates went up when they came down. They're kind of that pent up demand that jumps back in, saying, "Oh, we got our last shot. Let's get in." So that postpones the real hit to housing, and you've had some of that over the last, certainly the summer months. I think now with mortgage rates at 7% plus, um, it's shutting down housing quickly. And I think the next 6 months and certainly the next 12 months, you can easily see a 20%, 25, maybe even a 30% back up in housing prices, a breakdown in housing prices. And you're definitely seeing it in the activity a lot. The realtors will tell you, the activity has really slowed down. The interest has really slowed down. That's part of why the bust is, probably second half of next year, is because it just takes time for all this stuff to work through the system for those reasons. You got people who will, if they get, if let's say the mortgage rate went from 3% to 4.5 or 5, when it came back down to 4, I don't remember what the numbers were. People aren't saying, "Well, I got to get back down to 3." No, they say, "Okay, at least we got a break in rates. Let's jump on now." So they think they're getting their last chance, um, and that works through, at various levels. But I think once you get up to here, if you've seen any of the numbers on what a 7% mortgage does versus 2.5 or 3% mortgage to the what you can afford, it's tremendously
Huge.
much. You can't buy nearly the same house because your mortgage payment has doubled. Um, so I mean, that obviously there are people that it doesn't, money's no object, but for the majority of people buying, that's how they were buying, is what can we afford.
Right.
And a move from 2.5 to 7 changes affordability in a huge way. So there's zero question in my mind that housing is going to get hit as hard as, the hardest it's been hit in, since 2008, and could be hit harder than that even. 2008, you had the subprime situation. This time it's a different dynamic, but I think this rapid rise in rates is a big one.
Yeah, I think that makes sense. And it's a really good explanation. Thank you for sharing that. Cause I was genuinely just curious from my side because I was a little surprised at how they seem to decouple a little bit. Moving forward now, we've talked a little bit about your general hypothesis that we see a pretty robust market run up or a melt up, as you refer to it as, before we start, this later capitulation. I'm curious, you've shared a little bit of background on what that looks like and what the catalyst could be, but could you dive a little further into detail in terms of, you've shared that you felt maybe last week is where we might have posted lows. So what really drives the next stage of this melt up in your eyes?
Sure. Yeah, let's talk about last week. Last week, I thought going into the end of last week, last Thursday, it looked like we were going to retest June lows. Basically, June lows were, I think, 3640 or thereabouts. We went
Mhm.
down through 3600 in the month of October, and last week, and it looked like it was going to probably stop, 3580-ish, I think, was about where it was. And it looked so that, and people say, "Oh, it's broken that June low." So you were talking about a retest. That can't be a retest or a successful retest. I said, "No, that's the way a lot of retests go, is they'll break by a little bit and then reverse. The market loves to get you guessing." And so when it went through 3600, I was hearing that. And then Thursday morning, when it went down to 3490, went down to 3500, that was a bigger break. And I had people say, "Well, now your retest of the June lows, that thesis is out the window." And it really isn't, or wasn't. Um, it was just a slightly bigger break to scare a lot of the weak hands out, to convince people we're going a lot lower. And then within an hour of the opening, it began building up the other way, and we're a couple hundred points or more above that now.
Yep.
And so I think that was a successful retest of the June lows, basically a double bottom. As crazy as that might sound, since it's 140, 150 points lower than the June bottom, but that's within the way, past bottoms, how they retest. Um, and so I think we're probably, I could be wrong. It could go back through there and go to 3,400 or somewhere around there. I think there's a very good chance that that was our retest, that we had a double bottom, and that we're beginning the next leg up. And I do want to explain, because people always say, well, is the melt up started? And I go, yeah, I just want people to understand the term melt up. The real melt up part of the next leg up is probably going to kick in after the new high. So 4,800 S&P, you get above that decisively, let's say to 4,900, 5,000. That's what will convince people that, hey, this is real. This isn't just a bear market rally, and you're going to have people coming in. That's when you can get the vertical run. Melt up means basically the parabolic part of a rally. So the melt up doesn't start at 3,500, or it's not a melt up now. It's a new, in my opinion, it's a new leg of a new bull leg of a secular bull market. So this, just like March 2020 to December 2021 was a full leg, this one will be, from 3,500 up to 6,000 plus, in my opinion. And I think that one took 21 months, the 2020 rally. This one probably takes half that or less. So, I'm guessing it could take 6 months or less, but it's basically the melt up is the latter stage of it. It's when you finally are in what I call the blow off or melt up stage, going into a top. But it is the rally that leads to the melt up. It is the final leg, in my opinion, and I think it's begun. That doesn't mean it goes straight up. You could rally, for a little while and then have a week or two of pullback. You could go straight up. So it's hard to know exactly how the path will proceed. But what I think is pretty clear is that we've seen the lows, or at least I believe we've seen the lows, and that we could run here pretty fast to 4,600, 4,650, and maybe pause there, pull back, correct, give it a chance to breathe before it runs. Because this thing's going to be a steep rally, it's hard to know. It's not going to do. You're not going to be able to count on charts and say it's going to do exactly this. I think it's dependent on how. First you're going to have short covering. You're going to have a lot of. We're in pretty high shorting territory. Those shorts, as this thing moves up, because they thought, yeah, we can rally to 3,700 or a little above. As this thing moves up above, say 38, 3,900, you're going to have more of them saying, hey, maybe I got to cover. Maybe this has more legs than that. Then as it moves further than that, you're going to have more people saying, more investors saying, well, the momentum's to the upside now. I got all this money on the sidelines. Maybe I better put some money to work. Both institutional and retail saying, I've been positioned defensively. Now I've got to get back in because this thing has legs. And then the final piece is when you get to those new highs, and I think FOMO kicks in. Fear of missing out kicks in, and everybody jumps in and says, "Oh wow, this is real, and this is going a lot farther." How the big question I get a lot is, how can you be so bullish when you're talking about a global bust next year? The economy looks like it's heading for a global bust right now. The Fed's talking about tightening for many, many more months. The bond market's been going against you. How can you be so sure you're going to have a melt up? And two pieces of that. One is the fact that we have sentiment at levels we don't get to very often. And by some measures, it's the worst ever, but certainly it's back to 2008-9 levels, or previous bear market levels like 1982 or 1987 or 2003. So you're at levels that historically have indicated you're pretty close to a bottom. It's not a timing element, so it's not like you can look at bear sentiment and say, okay, I got to buy. But it does say an awful lot has been built into the market already, discounted in terms of the bad news. When you have sentiment at that level, and you have, you don't have to look very far to hear people talk bearishly. Everybody's, as I say, everybody's on one side of the boat. They're all sitting on one side of the boat, negative. And if you get this thing moving against that view, you got an awful lot of firepower there. And I just described different kinds of investors, short covering and institutions and retail, and some that are momentum and some that are just long-term investors that got scared. But you have an awful lot of people who, for different reasons, are going to say, my gosh, I'm missing this. And my gosh, I can't afford to be this defensive, with so much cash. It's going to start punishing institutional investors that have bogeys to meet, et cetera. So as it moves up, and then psychology is the other big piece. As it moves up, people chase momentum. The psychology, people are most bearish at the bottom and most bullish at the top, and the tape draws them in each direction. So as the tape got more and more negative, investors got more and more negative. As the tape, meaning the day-to-day movement in the market, gets more and more positive, investors will become more and more positive and put money to work. So that's, psychology is a big part of how markets work. So that's, because we're so positioned against the market right now, so bearish, it's pretty easy for me to say, once this thing gets started, it has a lot farther to go than people realize, because everybody's been, in agreement that it's going a lot lower, and they'll have to reverse that. So that's one. And then how do they fundamentally get there? And what I say is that once investors, and particularly institutions, but retail will follow them, once investors, the institutional investors, get the sense that the Fed's tightening cycle is coming to an end, that they went too far and the economy is really getting weak, they're not looking at today's earnings or today's fundamentals and buying or selling stocks based on that. They're looking out 6 to 9 months. They're looking at what will the landscape look like a year from now, 9 months from now. Once they get convinced that the Fed is done or almost done, they will start looking over the trough in the economy, the trough in earnings, and they will start factoring in, let's say, 2024 earnings. And so they'll be able to say, yes, earnings are getting, the quarterly earnings are getting worse, but we don't care about that because that's already discounted. We're looking over the trough to the next cycle. That's what I think, particularly that move from, say, 4,800 to 6,000 or 7,000. That's what that move will be mostly, is the belief that, hey, the tightening cycle is behind us, and this is 2009 again, or this is 1982-3 again, or this is 2003 again, where you have a full cycle ahead of you. So you need to get back in because there's a big cycle in earnings coming. So that's what, again, I'm not saying that's what ultimately happens, because I do think this is the last hurrah, not the beginning of a new cycle. But that's how I think it will draw investors in. That will be the narrative that drives the market.
It's interesting. You actually did a really good job, I think, as well, explaining the initial catalyst, because that was going to be a follow-up question, but you hit it right at the end. Like, what actually gets the wheels started moving, from here to that, 45, 4,800 handle. But I think you shared that pretty well. Thank you for that. One of the things I want to make sure we touch on is, let's say we get this melt up and we're now hanging out around 6,000, between 6 and 7,000 S&Ps. What starts the conversion then from that last blow off top into this global bust?
Yeah. So as I said before, it's not, some people think when I talk about the recession now and a global bust next year, they think somehow they're two different things. I go, no, the recession ultimately morphs into a bust because things progress to that point where, banks start failing and things start happening. You know, I think traders have a hard time with it because they're thinking in the moment. They don't realize that this stuff takes a long time to play out. I'm forever saying you got to let the cycle play out. And that just means it takes months and months and months for all this stuff to piece together. Just like your question about housing, it doesn't all happen the minute rates go to 7%. It happens over time because there are different people out there in different places in terms of their um, position to buy a house or what have you. So and plan to do it. Um, so inventories build up, and you've got to correct inventories. That's a process. All of those things. Um, so it just takes time. But once we get up to the top, psychologically, most people are going to be all in. So the investor, looking at the market, the investor is going to be most bullish at the top. He's extremely bearish now, and when the market's up, up 2 or 3 thousand points from here, he's going to be fully bullish, and he's going to be arguing with me, who's now turned bearish, as to why I'm wrong. Because don't I understand? There's a long cycle ahead. The Fed's not tightening anymore because the economy is so weak. But the other piece to this is that the economy can get a lot weaker because of the damage done now. That whole thing of staying too long now, and I think what's going to happen around the world is you're going to have a crisis financially like we haven't seen. So it's going to require a lot of effort on the part of the Fed and other central banks in terms of pumping money, and on the part of governments to try to prop everything up. I think it's just going to be a huge mess. So, and there's pieces of this I can't know yet, but I suspect, given the Dudley thesis, imagine what Powell and Dudley are going to be thinking if the market's at 6 or 7,000 when they thought it needed to get to, say, 2,500 to tighten financial conditions. So they're not going to walk away from tightening. Now, the street isn't going to be worried about that. They're going to feel like, because the economy is weak and inflation has come down a bit in the next, say, 4 or 5 months, they're they're going to say tightening is behind us, or at least for a period of time is behind us. But I think the Fed's mindset is going to be, we have unfinished business. Yes, inflation's down. I don't know where it will be 6 months from now, but let's say it's 5 or 6% on the CPI. They're going to say we're not at, we haven't beaten inflation yet. It's starting to come down, but there's still risk. And guess what? We got a very speculative market here with investors at hyper risk levels again. Very bullish and speculating. We need to tighten again, and we need to get this thing down. So again, I think Dudley's thesis is going to rear its ugly head and will play a role in that top. I think they'll be back to tightening. The market will probably ignore it initially, but I don't know for how long, because I think if I think they've sown the seeds to a bust now, and then they come back and tighten again, they're exacerbating something. So and again, there's leads and lags to all of this. So it's not going to be evident in the results immediately. In other words, if they raise rates and yet the market's moving up, people aren't going to necessarily say, "Oh, wow, this hike in rates is dangerous." So they may not. It's not like a bell's going to go off and people say, "Okay, I made my money, now I'm getting out again." They're going to be getting in. they're going to think there's a long runway ahead, and they're going to disagree with the Fed.
Got it. And I know we're coming up on time. There's just two questions I have left for you. The first one is, what's your take on the relationship and the behavior that we're seeing really in the bond market right now? I've obviously I've been trading for a while, and a lot of times I'll trade risk on, risk off relationships. And this year is very interesting in that that relationship is obviously different than it's been historically. I'm curious your thoughts on how bonds are behaving and what that looks like going forward.
Yeah, it's certainly been a surprise to me. I was this summer saying it looked there was a setup where it looked like you were going to run back from 250 to three and a quarter, and then head lower, and it pushed right through that three and a quarter and has run up to four and a quarter here, a little higher. And so that was not in my I didn't have any foresight in that. I missed that. But I think it is part of um, traders have gotten caught in what the Fed is doing, which is watching CPI every month. So if you go back and look, September CPI came in, everybody thought, okay, they may, if not pause, at least start lightening up on the rate hikes, because September's CPI may start showing that we've peaked in inflation and it's starting to come down. Well, instead, we got a higher CPI print. Part of it's technical, part of it is the makeup of the CPI and the fact that it's imputing rent. Rent probably peaked a year ago, but it's making it look like rent has a lot further to go, et cetera. So CPI was a surprise, and the market is just hyper tuned into CPI now and tuned into anything that goes with the narrative that the Fed has a long ways to hike here. And so that kind of hit the markets in September and again here this month. But I kind of lost my train of thought. What was so that pushed the rates up. Once you got above three and a quarter, then you went back to the highs around 348, I think. Once the 10-year got above that, it became just a technical run. And then this most recent jump, and I thought, okay, we had gone up above four and then came back down, and it looked like we were going to go back and retest, 408 or wherever it's gotten to. And it just pushed right through that today and went all the way to 431, I think. I think it's really just kind of a little bit in the same way that the stock market had to go to 3490 to get investors spooked enough, and get investors to start extrapolating that into, oh, we're going to 3,000 or what have you. I think the 10-year going to 430, all of a sudden everybody's on the out on the ledge saying, okay, we're going to 450 or 5%. In other words, I think it was the capitulation sell-off potentially. It's still early to know that, too early to know that, but I think that may have been just kind of the last gasp to get all the weak hands out of the bond market, and then you can start the reversal. So if I'm right, rates should start coming down between now and the end of the year, maybe fairly fast, but certainly roll over and start coming down. If I'm wrong and it heads higher, I'm just missing it. But I don't think right now, and I look at a lot of things, I don't just look at what's the 10-year going to versus what the stock market going to do. There's a lot of factors out there right now. A lot of my cross market stuff and things are more confirming my belief that we are at a very important reversal point here, both in bonds and stocks. Bonds are lagging here a little bit, so you got to wait and see. Stocks, I think we bottomed last Thursday. If bonds follows through next week and you get more rally, I think it'll just add more evidence that maybe today's action, this morning's action in bonds is a lot like early morning last Thursday in stocks, meaning that then they reverse.
Right. Got it. And we're pretty much buttoned right up to time, but I got to make sure I squeeze this one in because I think it's still really pertinent to the broader picture here. How do precious metals fit into this picture for you? I've actually been really surprised at some of the behavior of gold specifically. I trade gold futures pretty regularly, and gold has been interesting to me. So I'm curious, how do precious metals fit into this broader hypothesis of us into the melt up and then subsequent bust?
Yeah, I'm glad we didn't leave this interview without talking about gold and silver, because I think we were at a huge pivot point in gold and silver, in my opinion. I've been bullish for a long time, and I keep thinking we bottom and then we go back and make lower lows. I think we're at a so I'm the boy that cries wolf, but I think we are at a major pivot point, and I'm expecting um, both the miners and the metals to begin to move up from here pretty aggressively. So, you could see a 15 or 20% move in the miners, let's say in the next couple of weeks. I think silver can, in the very short term, silver looks like it's got room to run to 22, 23. Gold, I think back over 1900. And in the course of the next, 6 to 9 months, I continue to call for gold at 3,000 and silver at 50 or higher. So I'm a huge bull on the metals. And when I did my work for my last letter, when I went back and looked, what is very clear is that gold and silver rolled over, and particularly gold, but gold and silver rolled over almost coincident with the dollar moving up back in April, March, April, and it it's almost entirely that. Rates played a role too, for sure, and most recently I think played a role in this weakness. But if I'm right, the dollar is about to roll over, and if the dollar rolls over, that's going to be music to the ears of gold and silver, investors. So I don't think it's a lot more complicated than that. Gold and silver are, in my opinion, as undervalued at this point as they've been in decades relative to other markets. And I think once they start going, they're going to get sponsorship. This idea that crypto is taken away there, particularly
Mhm.
gold, taken away from gold, may have in the short run attracted people that would have otherwise been gold buyers. But I think the story really was the dollar. And again, we talk about rates when we talk about the Fed, but the truth is that the dollar being where it is because of Fed policy. It's another reason why I am so adamant about saying the Fed's making a huge policy error, because they seem to ignore, the dollar in just in 2022, just this year, just 10 months, the dollar has moved from, I think, 95, DXY from 95 up to, 115 or whereabouts.
Yep.
God, that's a huge move, with the Fed and the Treasury not even paying attention to it as if it didn't matter. That's why I'm surprised we haven't heard more from foreign entities, and why I'm surprised central banks haven't been on the phone with the Fed over and over saying you got to do something. I mean, look at what's happened to the yen. Now again, that's a lot of it inflicted there, and it's going to lead to a disaster there, because they're about to um, depeg interest rates. They've been keeping their rate at a quarter. And if they let that run, they don't have they're gonna run into real problems given what they've done over the last several decades with how they've held things together there. So there's plenty, and that will be part of the bust as well. There's plenty of things out there that will, a year from now, be front and center in the global bust because of policies that have taken place here in the last few years. But I think if the dollar is rolling over as I expect, gold and silver are about to have big runs.
David, I know we're at time, and thank you honestly for taking some extra time on that last question. It was kind of an unfair one to throw in at the last second, but I wanted to make sure we had a chance to talk about it because it is, I think, part of my general curiosity as well. And one thing I want to make really clear to people who listen to this video is I definitely see a lot of folks comment about, oh, well, this didn't happen or this didn't happen at that exact point. And what I think is so powerful about the information you share is the thought process. You share the things that you look at, the relationships between different factors. And I learn so much every time I talk to you. So thank you so much for taking some time to chat with me and to share your experience with the broader community. I think it really is super useful.
Yeah, if you don't mind, I just want to comment on that a little bit because it
Yeah,
is
please. Sorry.
what I see on Twitter too. Um, I really believe, and this dates me a lot because I was in this business before computers were on our desktops. So I really believe that what we've evolved to now on the retail side, it's true on both institutional and retail, but on the retail side in particular, they are now bombarded with all kind of information. They have their fingertips, you know, charts and things that they can see second to second, minute to minute. And unfortunately, I think what has happened, and again, this is my view, but I think what has happened is it's turned a lot of people who would have otherwise been investors into traders. And somehow, I think a very large chunk of retail investors somehow believe by watching the market every day and watching it minute to minute, they're more on top of their portfolios and more on top of what's going on. And what it's leading to is expectations that things are going to happen quickly. Again, the institutional traders, I oversaw a trading desk when I was chief investment officer or head of a equity department. So, and I had good friends that were traders that worked for me. And traders have a different personality, a different mentality, and they're watching markets from a different perspective than a portfolio manager. So I'm not putting them down, but traders, retail traders, unfortunately, I think a lot of them don't understand how long it takes for things to play out. So my biggest critics on Twitter, and the reason I have so many people obsessed, because I'm the most extreme bull and I'm in a bear market, but a lot of them, what I see in the criticisms is a lack of understanding of what a big picture macro call is versus a trading call, or how long it takes for the big picture to play out. And I'm not just using that as to kick the can down road, say you got to let it play out. It's a cycle call means it takes time to work through that. And so I'm focused on, where's the market going to be at the top. I'm not necessarily focused on what's the bottom in the market on the way to that top or what have you. So, I'm not, or if I think you're going to make a double bottom and it goes a little lower, that's not my focus. So,
Right.
but the most important piece of what I wanted to say was just that I think if people could understand that watching the market so closely is typically counterproductive for most of them. There's exceptions. Some may be really good at picking things off and doing the short-term trading stuff, but most of them are investors, but they think somehow watching it every day means they're getting more information and they're going to be better at it, or better at understanding what's coming. And what I see is complete opposite. I think it leads to almost a blindness from watching things too closely.
And not to draw it out too long, but I couldn't agree with you more. I'm a trader myself, and I've noticed my evolution where that exact thing happened, where I wanted to trade short time frames. And then as I started integrating longer time frames, I actually started becoming far more successful in trading. So I'm really glad you bring that up, especially from a trader's perspective. And I think that's actually one of the reasons why I love talking with you, is because folks with your perspectives, you force me to zoom out. You force me to consider an alternative way of looking at the bigger picture. That you're absolutely right. A lot of traders get sucked into, the X move that S&P 500 made today. So I really appreciate that perspective, and sincerely, again, thank you so much for taking some time to chat with me and share your information. And obviously, would love to have you on again in the future. And until
Sure.
next time, no, thank you.
Okay, Eric.
Thanks, David.